Hello, everyone. This is our 3 p.m. afternoon webinar and to share our knowledge with you. And most of these knowledges are also the one that you really need to know at this time. For example, today, we're going to talk about year-end inventory accounting and to talk about year-end inventory, right? And if you are in the retail business and you know that you have a bunch of, you have a bunch of inventory that are sitting on the shelf, you're trying to sell over the holiday season. And at the end of December, because of your tax accountant going to be calling you, ask you, hey, what is your inventory value you have? And you'll be sitting there wondering, okay, I counted yesterday, this is how much, but a lot of them are really outdated. I'm not sure what to do. So these are practical questions related to inventory. And if you're in an industry that your inventory expires really fast, like in the grocery store, right? Or even if you're in the electronic compliance side of business, those inventory, after a period of time, for example, if you have if you sell, say, notepad, electronic and iPad kind of devices, and once you over a certain period of time, their value is not the same anymore. So year-end inventory counting is so important. So we think that you should know, a couple of things related to that. So let's go ahead and share our screen. So this is our new website, folks. We have them updated. And one of the exciting feature we have here is appointment. You literally can set up appointment to see us and you'll pay a fee online, but you will know our schedule without even calling us. Like if you want to know my schedule, you just go on to make appointment and I'll be there for you. Okay. And this is our new website and you can actually, right here, this is where you make appointments. And over here, this is what you make payment to us. And the portal, if you are our client, and you can select the languages you want to see our website to be with. So, and another thing we always talk about, it is the YouTube channel. Subscribe to our YouTube channel because we share all our knowledge here. And after I talk today, and it will be on the YouTube channel. So you can always go back to search for inventories. So for example, we are talking about inventory right now, right? So if you just type into inventory right here, you see how I typed it in and I just press enter and all of the things that are related to inventory would come up. So you don't have to listen to what I talked today and you can go back to what I did before. And the inventory side of knowledge, it didn't go outdate because not like certain tax rules, they will update and the inventory is pretty consistent. So we still are pretty much the same compared to this year and the prior year. And now let's go ahead, start our conversation on the inventory. And before we do, a couple of things, and this is a form information. I just showed you the website and our YouTube channel name is Community CPA. So you can actually just go to YouTube channel and youtube.com and type into Community CPA, you will find us. Subscribe to our channel. And we want our channel to go subscribership to be over 6 digits. We're right now only 4, so we have a long way to go. And we also have Facebook. If you're watching us right now on the Facebook stream, and this is our address on the Facebook, and our firm, we are pretty interesting. We can speak 9 different languages collectively, not by myself. I wish I could, but collectively we can. And we have 4 different locations. And our number 4 is in Capitola, California, and it's still under construction, but that's our number 4 branches. Otherwise, we have in Des Moines, Iowa City, and Bloomington, Minnesota. And our content, obviously, it is our experience, our knowledge, and our opinions. So we don't take any responsibility. And so we have this slide to make sure that you understand. If you do want us to help you, and of course, you can engage us for professional service, right? All right, let's talk about inventory. Every year I have clients would come to me, goes, I'm so tired of doing this inventory. Can I just not do it this year? Of course. And if you really don't have time, you use estimate, and that is still better than just not doing it and then let your accountant fill in the number. And our tax accountant don't fill in the number for you. And if you don't have an inventory number provided, and you don't know what your inventory is, and at our firm, what we do is we actually will kind of give you what you had last year or what you had before, and have you lay out your store. Because a lot of times when you say you don't know about your inventory, because your mind is thinking about the items, you're thinking about, oh, I don't know how much those cans and the bottles worth. I don't know. It's too difficult to calculate. But if you get to the point that you just don't have a system, you have a massive amount of inventory, and you can classify them into groups. So knows that this group is $5 per unit, and I have about 100 of them. And that group is about $2 in average a unit, and I have how much? Or you can look at your shelf, knowing that this shelf is all kind of related to seafood, and our seafood price is this, so you kind of can do your best estimate, right? Even that estimate, we needed you to have a documentation, because you can't go through audit with IRS or with the state by saying that I don't know what that number is and I just kind of estimated. Even if you estimated, we need you to have some sort of a plan and a paper to lay it out, to estimate it with the best effort. Did that make sense? So it is important. And the reason for the inventory to be important, have you ever heard of people telling you that, oh, the higher the inventory you have, the more taxes you pay? And you're sitting there goes, how could that be? I spend money buying inventory and you're saying that I need to pay more taxes. Yes, that's exactly right. The higher the inventory value you have on your balance sheet, the more profit you're going to make on your income statement. Therefore, the more taxes you will pay. So that is how important. If you want to pay tips to IRS, you want to pay more taxes, absolutely. Don't worry about your inventory. Book it as high as you can. And then you have a lesser cost of goods sold. And then, of course, you're going to pay more taxes, right? So that is the reason why inventory number need to be on the balance sheet. But a lot of you would say that, I know how my inventory is because I know how much I bought it. But with time, it is really not worth it anymore. And how do you account for that? Then again, I go back to what I said, to categorize them, right? So you have a category of produce only lasts for 7 days, and you bought them in the last week of December. And by the time you arrive, December 31st, they either get sold or they already expired and need to go to chicken coops or feed the pigs. It's not really something has value anymore. So in that case, what do you do? So in that kind of situation, you have this what we call the inventory write down, inventory adjustment, inventory shrinkage, and the inventory write-off, inventory spoilage rate. So those are all the different terms people are using to adjust their inventory below the purchase price, below the cost. So the basic accounting principle on inventory, among all these slides, the most important sentence is right here. Under U.S. generally accepted accounting principle, inventory is recorded at what? The lower of cost or market value. There you go. So as a business owner, you have your due diligence related your inventory value. You, of course, can use what you purchased because that is the cost. But you also have your business experience to know the market value. So maybe your cost is $1,000, but your market value is $10. Then when you report your inventory value, you don't report 1,000, you report $10. Then the rest of it, it is part of cost of goods sold. If you like your accounting to be squeezy clean, and you will set up a category, call that inventory adjustment. You are adjusting $990 into cost of goods sold to reduce your profit. So that is a proper accounting procedures that you should follow and you should do. A lot of times in our small business owner, small business world, a lot of time the business owner are so smart. They're actually doing something like that, but they're not using proper theories and the proper procedures to guide them. So many years ago, we received the new grocery store owner. They coming in to do their grocery store accounting. So I just happened to ask them about their inventory, and so the owner said to me that, oh, it is so hard to figure out. Even if I figure it out, yeah, and the value doesn't look right. So I actually just make sure that I write down, I discount this 50% of it. So he used the word of discount. And in inventory world, and we write down the inventory based on the market value. But our small business owner would say, oh, I don't know, I'm just gonna take it off for 50%. And if you get audited and IRS auditor come to you, ask you, can you show me how your inventory number come about? You go, I don't really know. I just kicked half of it out, and so I just count half of the value I think I have. And if you say that, really, the auditor don't have any choice but deny your inventory number, and the auditor don't have any choice but start working on your accounting, figure out how much you bought it total, purchase total, and also estimate what is your cost of goods sold rate to your sales, then back out the inventory value for you. The way they're backing it out is the cost, is not market value, but they can't go for you to reduce your market value because they're not in the business you're in, and they don't know what your shrinkage, what your expiration, things like that. So that all causes complications, but the auditor is doing their job. They are using the information you give them to back into your inventory value. Then the higher of the inventory value there is, the more taxes you're going to pay. Not a good picture, right? So it's really important to understand what you are doing, even though you have been doing the same thing, but you need to give that glory of theory and knows exactly what you're doing and how you write down from the cost to the market value if market value is lower, right? And then again, people say that the inventory value is just a think number. That is because they do involve subjective judgment on the value of the inventory. And my advice to you is that you can consult to the professionals to have them give you the category of the inventory that would need to be considered. And with your experience in your industry, you can come up with annual write down for these inventory. So that way you can prove to the IRS and prove to the compliance officer that you actually are tracking inventory due diligence in terms of the inventory value. I mean, I have never ever seen IRS auditors being unreasonable when you have such a good theory backing and also method backing for your inventory calculation. And it is worth an investment when you have that much of inventory and the cost of goods sold running around between your balance sheet and the income statement. All right. So nowadays, when you run business bigger and you have inventory computerized system, right? And I would always say to folks that the leap between small to medium business, it is not your ambition. It is not your hard working and you don't sleep. It is actually the computer IT. If you want to grow your business to a higher ground, you have to have a reliable and computerized system with integrity to bring you to a higher ground. And I cannot say that enough. So I almost, in our business, where we kind of are sitting here watching all these 10,000 businesses, our firms are handling, and there are clients growing from small to big pretty fast. There are also people be the same way for 20 years, no change. There's also people run down and close, right? So if you ask me, what is the most important or most noticeable uh, benchmarks in terms of what business will scale, what business will fail? You know what I would say to you? It is the system. And if you're running a inventory heavy business, your inventory fluctuates all the time. The cost is always different. The market value, the shrinkage amount is always different, or they expires really fast, and you don't have an inventory system. That just tells me that you want to stay small. You want to stay so small that you can use your 10 fingers to figure out your accounting. If you cannot use your 10 fingers to figure out your accounting, you need a inventory system. All right. One thing I want to bring it to a highlight of this afternoon is dispose of unwanted inventory. And I have clients would say to me that, oh, Ying, I can't dispose the unwanted inventory. What happened if I happen to sell them? Nothing happened. If you, let's say you have an inventory worth $100, and you really believe that it's not worth anything. Nobody wants it. I had it for 5 years already. Nobody even buy it anymore. So you write that $100 down, right? As adjustment to cost of goods sold. So your inventory of that $100 becomes zero. And then your cost of goods sold is $100 more because you dispose the unwanted inventory. But what happens as soon as you did that? Someone walk in, goes, I want to buy that item, and here is the $200. So normally $200 minus $100, you make $100 gross profit, right? But in this case, your inventory was written down to zero. So you got a $200, then you have no cost of goods sold. So you ask me, oh, what's going to happen if I write them off and then they happen to, show up and to buy it? What am I going to do? Nothing. You're just going to account the sales as 100% gross profit without any cost of goods sold to reduce, right? So the way to clean up your unwanted inventory, there's many ways. You can sell it to liquidator to get a little bit of value out of it, right? And you can donate that to the nonprofit organization. When you donate, and you will use the cost of your inventory as the in-kind donation into the nonprofit, and nonprofit will give you a documentation of how much you donated, and then you can report that onto your business book. And of course, donation depends on your income. Donation is not 100% deducted, or it is not like expenses to be deducted if you're S corporation. So there's a different treatment to donation. But again, and you can donate that, right? You can also use your inventory, unwanted inventory, as a part of the inventory that sells as a going along item. Then of course, your profit margin will shrink just because you put your unwanted inventory in the cost of goods sold. But those are all ideas for you to dispose your inventory, but you absolutely can write it down to zero, leave it in your storage room. If someone happened to buy it, you just have your sales equals to gross sales. You don't have a cost of goods sold to deduct it. So the inventory value is high. Here I summarize what I said in the beginning. Your cost of goods sold is low when inventory value is high. And your profit would obviously be higher if your cost of goods sold is low, right? So you pay more taxes. So that is how the equation goes. But if you just don't want this middle things about cost of goods sold and you don't want to hear me talking about that, I just want you to knock in your head, if inventory value is high, your tax bill is high. And that's all. And if you just remember this today, that will give you a little importance for you to know what number to give your tax accountant. If the number is too high, you're paying too much taxes, and then maybe a inventory study is needed. Okay. If inventory amount is low, you would have a higher number of cost of goods sold, so more expenses and less profit. Then, therefore, lower income tax, right? Now, and the last piece I want to remind everybody is the the inventory that you written off, and nothing to worry. And if you sold that inventory you wrote off, and you're just gonna account 100% sales price as your gross profit. You see, I didn't say to count as your profit. I said gross profit, which means that before your other deduction, right? Your rent, utility, salary, all of these overheads. So it is, your sales price equal to your gross profit. Then your gross profit reduce all these expenses. Then you have a profit. That profit is taxable income. You will pay income tax. So that is all for today, folks. And you can email Catherine at communitycpa.com and to tell us what you want to talk about. And this Saturday, 3 p.m., I'll talk about the steps and you need to go through when you lose a loved one. And, with pandemic, this comes up a lot. And nowadays, I don't know what's going on with 2022. I want you to tell me whether you agree with me. Don't you have more people that leaving this world and, gone? And that happened to me. I mean, I have some friends and I would never ever imagined they would be gone, and they did. You see, I was even saying they, I'm not saying she, one person, there's more. So when that happens, when you have a loved one living you, and you ended up handling the affairs after fact, and what exactly happens on the tax side, a general guidance for people and who should follow through. And I know a lot of us, a lot of small business, we don't really have billions, millions to in the estate. Our parents don't have that. And so what that mean? And what does that mean to me? And what do I need to do? So we will cover that on Saturday. And I will see you again. And folks, have a good week. And this is only Tuesday. And going through the week safe. And I'll talk to you again. See you on Saturday. Bye-bye.